So currently, the world is facing a structural financial issue where for the past 10-20 decades, a lot of investors picked up loan from Japan at a very cheap interest rates, nearly zero or sometimes even negative. On August 2024, this has reversed. When Japan was facing a lot of inflation, a lot of salary hikes due to the COVID impact, what is happening right now is Japan has started increasing interest rates. The complete story of Japan I have mentioned in one of my videos. But keeping that aside, Japan has started increasing interest rate and the overall liquidity that is picked up from Japan, a lot of economists suggest that it's around 4 to 10 trillion dollars. Where does this 4 to 10 trillion dollars goes to? It goes to stock markets and a lot of second world and third countries stock markets like India. And in India, we are seeing a similar outflow of foreign institution investors due to the fear of war because of higher inflation rates. So when you map all these things together, what we see is overall financial pillar of global economics is being shaken by its core. One simple events of increasing the interest rate by Japanese bank. A lot of senior economists suggest that this will not impact Japanese economy at all, and it will not impact in the short term. It will not impact the global economy as well. Something very distinctly different is happening throughout the global stock markets. August 2024 was the period when Japan started increasing interest rates, and September 2024 is when the Indian stock market Nifty 50 peaked. The Nifty 50 tried to reclaim that high, but due to war, it started dipping again. Some of you may be thinking why the Japanese money matters so much to the world. And for that, you need to understand that Japanese money or yen carry trade. The cheapest way an investor or an financial institution can go into the markets and pick up a lot of cheap money from. A lot of this cheap money is usually goes into very high risk return assets or very safer options like US Treasury bonds. Go and search which country is the largest US Treasury bond holder, and you will be shocked that it is Japan. So a lot of this cheap money has funded US Treasury bonds. US Treasury bonds is nothing but money borrowed by the US government to funnel its own growth. So a lot of Japanese money is going into USA to fund the growth of USA. And when the US government or US banks gets a lot of funding, what they do is they disperse loans through companies and a lot of individual investors, individual borrowers. These borrowers may be financial institution investors. They go and disperse the money through global stock markets like India on the currency. So due to this financing activity called Japanese yen trade, the whole supply chain is entirely or most predominantly dependent on the money coming from Japan. And anything that impacts Japanese economy has a ripple effect on rest of the world as well. And now we see that Japan holds more than $1 trillion of US Treasury bonds. And if Japanese inflation is not under control due to war or due to employment wages due to the COVID impact, what Japan government will do is they will go and sell the US Treasury bonds, which will impact the dollar itself. The dollar will fall in terms of yen. Yen will become stronger, dollar will slip down. To avoid this, both the governments are doing a lot of things that can protect their currencies, which in terms will tighten the financial condition throughout the world. The cheap money which has been flowing for 10-20 years into the market will be squeezed dry at certain point. That's what a lot of investors are fearful about. So whatever outflow of money that you're seeing from Indian economy is not just the oil politics, the oil stress. This is also the global rattling of economic pillars that we don't see if we have just focus on the Indian ecosystem. We have to look at a broader picture and where the money supply chain is getting impacted. For the India, This rattling of economic supply chain creates three major problems in the near future. The first is Indian economy is not at all attractive for the foreign institution investors to make money. The global economic situation and the war going on in the Middle East has made Indian economy somewhat unattractive to the foreign institution investors. So they are trying to move out of risky assets. If you calculate all the taxes that the institution investors are paying for long-term capital gains, short-term capital gains, depreciation, inflation, if we include everything, they are not making enough money in Indian markets. And even you are not making enough money. If you're a common investor in India, a lot of your investment returns is being eaten up by depreciation, inflation, and the taxes that you're paying. Indian government is sucking you dry. The second thing is US is playing the currency war right now. So a lot of investors, when they move out of India, they will go and look for high yield return investments. And US Treasury bonds is one of them. So the demand for USD has increased throughout the world. With the war, a lot of oil purchases are also getting impacted. And oil is also predominantly bought and sold in USD. So USD is getting stronger. So yeah, Indian government got one thing right, that Indian INR is not dropping, US currency is getting stronger. Because Indian INR doesn't have an edge in the market. But it's not all the fault of currency war also. India has such a bad tax regime for the investors. They are basically punishing all the investors for all the long-term gains and short-term gains. It's not at all attractive for anyone. And in the short term, I would hope that Indian government suffers from this, so that they have to take drastic measures to completely remove the tax systems on long-term investing. Tax system on gold. Taxes doesn't help common Indian people, because depreciation and inflation is eating most of the returns. Third is that in the near future, a lot of companies may face issue in terms of debt. If they have taken debt from the foreign institution investors or Chinese investors, with the falling rupees, they have to pay more because dollar or yuan is increasing, let's say. So they have to pay them in their own currency. When this financing happens, the particular company has to pay more interest, which basically puts stress on the financing activities within a particular company. So the key question right now is whether Japan will keep increasing the interest rate at traditional pace. If that happens first, or the global unwinding of the yen carry trade and whatever the cheap money is rotating into each country, which will create a cascading outflow of money from the Indian economy, the US economy, the bond markets, the stock markets. So you have to keep look at all the supply chain that the yen carry trade impacts. In my sum of videos, I have also explained how everything started with the impact of COVID. And there is a recurring pattern that is happening currently. COVID, war, the bubble, AI bubble. It creates a pretty interesting scenario, which all these three situations is just adding stress in the financial systems. It just requires a pinch of uncertainty or unwinding to create a global ripple. And this global event can then snowball into a black swan event. Anyway, that's a different rabbit hole to go into. In the coming videos, I will be going through a lot of these rabbit holes and try to explore what are the key issues in the system is, so that we can predict some of the irrational behaviors that may happen in the coming future. So if you're interested, keep watching. See you later.